Hello, everybody. Thank you for joining us for today's public webinar. Good morning, Jim.
Good morning. Good morning. Okay, we're going to, as most of you have heard us say, the reason we do these free programs is in order to keep attention to the educational programs that we have. We've just finished a primer, and what's the date coming up for the intensive?
It will run from October 4th till November 2nd.
Okay, and if anybody takes the primer that hasn't been with us before on a primer or a foundational e-course, the foundational e-course is a prerequisite for the intensive. But we'll come back to that in a minute. Let me walk through a bigger picture of what's going on in the market, at least in what I've been talking about for some period of time. And the reason to do this so many times, I've been watching what a lot of short-term traders have been doing recently, and I think a lot has to do, a lot of the problems some are having with not understanding the larger process that's going on. What I've been writing about is the market is in a three-phase step, what I call a three-phase step. Step one, or phase one, was when the market hit the highs. What went on, what caused those highs to take place were two things. The longer term money managers were underinvested. A couple of years ago, or a year ago, everybody was talking about there's going to be a recession. That was about almost an 80% probability, everybody thought. So there was a tremendous amount of long only managers that were underinvested, which means they either had too much cash or they had securities that didn't have enough risk with them if the market started to rise. Secondly, a tremendous number of hedge funds were short. They got squeezed over June and July. As the hedge funds started to get squeezed and forced to cover their shorts, that brought the long-term money managers in, and because they felt the squeeze. It's what we've been talking about and called the pain trade. Pain trade is just nothing more than what markets have a tendency to do, what causes the most pain and discomfort for everyone. So that was what was taking place. That everybody got excited about that. And we had, people talking about markets going to new highs, etc. And what they didn't appreciate, that we were looking at old business. Short covering is old business, not new business. And short covering weakens a market. And I know some people have trouble understanding that because on the first stage, it doesn't. But as the short covering gets underway, people are buying back, existing positions. And if it's combined with new money buying, then it may continue. But this wasn't sufficiently funded by new money. It was mostly short covering. That took us up to phase one. That brought the end of the market. Then phase two came down, and the laggards, we talk about the diffusion model, which is made up of the innovator, early adopter, early majority, late majority, and laggards. Then the laggards were in the market. And the way we identified the laggards, there was a trend line, and for 11 out of 13 days, the low was almost the tick to the trend line. That is behavioral characteristics of laggard traders, the last ones in. They finally figured out, after all these times, the market was going up. Phase three started to open up as we got down to the 4,500 level. There was a huge gap below the 4,500 level. And we need to get to phase three, brings in the liquidation of longer term holders. Now, the reason that you are looking at a monthly bar chart in front of you right now, July was an inside month. So the market's been one time framing higher for the last 3 months. July is an inside balancing month. Now, what we don't know at this point in time is the market softening just to bring inventory back into balance a little bit before it goes higher. And it clearly could go higher because there's no real meaningful excess at the highs. But sometimes markets have to break before they can rally. And I don't know if that's what's happening here, but sometimes they have to break before they can rally. And what that means, it chases out the weak longs. Those weak longs get replaced with stronger longs. Now, how do you make the best judgment of that? Well, the July low was at 44.1950. You've watched the market recently continue off the 4,500 level. The market came down a couple ticks short of 4,500, then it took it out by a couple of ticks, then it rallied like crazy, then it came back down, took it out by a few more ticks, rallied again very crazy, and it loses emphasis every time. The best way I can explain is what goes on. If you take a quarter, spin the quarter, and the quarter's got a lot of energy when you first spin it. After a little while, all of a sudden the quarter goes flat. It's losing energy continually. So every time this market rallied, it lost more energy till it went flat. So now we're in a stage right now where what we don't know is, are we just seeing liquidation to bring inventory back into balance before the market goes higher, or is there something more serious going on? The reason I've marked 44.1950 on the chart, that was the monthly low taken from the profile. So far, August is an inside month. An inside month is just a form of short-term balance, and that's how the market's been trading, with a lot of rotation back and forth. If there's anything more serious in here, then I think we go down and before the end of August, we take out the 44.1950 low. Then the odds are that we have a more serious liquidation underway in the market. Now, we also saw that yesterday in particular, we get a setback in the fixed income market, and of course this is a very deflationary, interest sensitive market. As we get ready for today, there was a knee-jerk reaction this morning. Overnight inventory is short for today. We are trading right now right at yesterday's low. So I don't have any, I don't have any clear value for today. What I want to watch today, remember, overnight inventory is short. Approximately 70% of the time, there is a counter auction or a correction to overnight inventory. If you don't get that correction to the overnight inventory, that is a sign of weakness in the market. About 30% of the time, you do not get the counter auction. The counter auction would be a rally. When the market opens this morning, if you don't get that rally, that's a sign that the market's fairly weak, and it will probably then go down and try and test the 44.1950 level. Maybe not be today, but within the next few days. If the market rallies today and we don't get any downside follow through, then the market once again will probably target the 4,500 level. Okay, Jen, why don't you talk a little bit about the upcoming intensive, and then we'll go back and take some questions.
Okay, so for those of you who aren't familiar with our website, you can go to jimdaltontrading.com, go to courses, and you'll see that the fall intensive is featured up at the top, and that we've got, the schedule here, so you can see the timings and maybe some of the different types of presentations that we would be doing. But as you heard Jim say, and you've heard me say before, the foundation and application of the market profile e-course is the prerequisite requirement to be able to join us for a live intensive. The only exception is folks that are grandfathered in because they have done an intensive in the past and it's verifiable. currently right now, we've got our early bird pricing that is ending on Sunday, August 13th. And so you can get a nice discount for purchasing more than one course. So if you haven't done the foundation e-course, you can purchase the foundation e-course and the fall intensive bundle for a discounted price through Sunday. We also have other bundles here. Maybe you're somebody who is interested in doing all of our courses in terms of both e-courses and the intensive. You can get a nice discount for purchasing all three. And then for those of you who are qualified to do an intensive with us, but are interested in the advanced nuances and exceptions e-course, we do have a bundle with the intensive and the advanced nuances e-course bundle here as well. You just need to go to the courses page and then scroll down. Okay, if you have any questions about which course is right for you, by all means, contact us at our email, delton@jimdeltontrading.com, or you can give me a call. I'd be happy to speak with you. But I will just say that the foundation e-course, you can see the details here. We've got the syllabus there. It is I believe, a 12-hour e-course, but there's a lot in it. So you'd have to repeat it definitely to make sure that you grasp and understand the material. We do offer a one-time web session meeting to answer questions with regards to the e-course in case that's the only course that you do with us. Just to mention about the intensive, sorry, my throat. For the intensive, all of the webinars are recorded. So if you are somebody who lives in a time zone that maybe it's not conducive for you to be able to join us for all of the webinars live, or you have a day job, no worries, because all of them get recorded. And when you purchase the intensive, you got access to the materials of that intensive for one whole year after it finishes, so that you have time to go back and review and rewatch the videos. So that shouldn't be an issue if you've got a day job, but it's something you're still really wanting to enrich and continue with your education, then that's a great way to do it.
Okay.
Did you want to say something, Jim?
Jen, take me to
Charts?
the profiles. And
Okay.
then what we'll do, I'll talk with the profiles, take questions, and then anybody that's interested, as we get to the end of this, Jen can take over and ask any questions that people have on the educational courses. Okay, so what you're looking at right now is the market. The market as of right now would gap lower, but you can see it's just hanging around yesterday's low. So what we were talking about earlier, overnight inventory is short. 70% of the time, approximately, there is a counter auction, which means a correction to overnight inventory. If there is no correction to overnight inventory, then that would be an indication that there's more weakness to come in this market. Okay, Jen, let's take some questions.
Okay. Does Jim use the COT or commitment of traders to find out what hedge funds are doing, or is it just his contacts?
No, no, I don't use commitment of traders. I used to look at that years ago. I never found that it really helped me much, and really found out what hedge funds are doing. It's not so much the contacts as I look at the market. I can read the markets pretty well of what is going on. I mean, you never know for sure. You never know for sure, but I do have a couple of people that I talk to. I actually have a couple of clients that run some of the largest trading desks in the world that have been clients that we've stayed in touch with. The last time I wrote about the hedge funds prior to talking to anybody, and one of our friends emailed back and said, you're absolutely right. So, but that did help me, because early on I didn't realize what the hedge funds. Early on I thought it was more the longer term money. Then I figured out it was the hedge funds by the way they were trading, and then this was verified by one of our friends. Okay, thank you. Next question.
Okay. Can Jim clarify or expand on phase 3 again that you were speaking of earlier?
Okay. Phase 1 is when the market finally tops out. And the signs of that, the volume is low. It just things dry up. Then phase 2 is usually where the laggards, are taking over. They're not joined by anybody else. phase three is where you start to get liquidation by longer term money. You may get liquidation. You may even get some new selling. I think we're in phase three right now, but I don't think there's clarity. And that's why early on, Jen, go back to the early bar chart, please. Okay, now, whoops, what did I do? So, and that's why I'm sitting there saying and focusing so much on, so far, August is an inside month. Sometimes markets get too long to go any higher. So you have to get some liquidation. The weaker, and those are the weaker money that's selling, they're replaced by stronger hands, and now the market can proceed higher. That's fairly common. It's no different than you hear that somebody says the long-term market is up, but the intermediate term is down. All that is just a sign of the market's coming into some balance. It's getting rid of some of the weaker hands, bringing some of the newer, stronger hands back into the to the market. Now, that's all. It's one possibility. And when I do my preparation, I always want to be objective. I don't want to get a bias that locks me into one way of thinking. Now, the other thing is, if okay, you get the liquidation, but if the liquidation the early liquidation, if it's not joined by new money selling, then the market turns higher. One of the things I'm looking at here to see how serious this is, right now, all we have is an inside month. The market's been one time framing higher. If we take out the July low at 44.1950, that's a stronger indication that the selling that's taking place here is a little more serious, and there's probably some new money selling joining those that were liquidating early. Now, one of the other things that I've been talking about in here, and I don't hear many other people, but I've been using the word contagion. And that's just simply where one market starts to spill over and affect markets around the world. And one of the things I've been following is that, China's turning down. So the second largest economy in the world is turning lower. And I'm not predicting it. I'm just saying it's something to be aware of, because that wouldn't be uncommon. Okay, additional questions, please.
Okay, let me see here. A moment. Okay, we are within, let me go to charts here. We are within the spike from July 11th. Can you share your thoughts on that? So that was at the July 11th. Yeah, this spike right here is what they're speaking
I'm
of.
not.
Is there any significance to that now that we're in that?
No, I think too much time has passed. And I have to be careful not to go back and look at too much stuff, because that'll give you cognitive dissonance. What I'm really looking at is the July low, how serious this market is. I want to say, there's another scenario. I mean, you could stay here for the rest of August, then September could open down below. September historically has not been a very good month in the market in here. Okay, but my focus really is on the July low. Now the market, we've got about 9 minutes till we change. The market is soft again. So now it's slightly changed. We're now dealing with a gap. So now with a gap, another set of guidelines are the gap trading guidelines. The gap trading guidelines are go with all gaps that aren't filled fairly quickly. And I don't know exactly what fairly quickly is. But if the gap isn't filled, then that's a sign of quite a bit of weakness in the market. If the gap is filled, meaning we open below yesterday's low, come back in and fill the gap, then we start to monitor for value throughout the rest of this day. Okay, another question.
I just wanted to point out, because I know that person who was asking about the spike, we are, okay, the overnight low is currently right here. So it seems like it might be a visual thing that traders are seeing, Jim, even though I know that that's far back, but.
Yeah, there are people who look at that. But again, like I say, I want to be, too many times we take in too much information. And I think what is far more relevant right now is the gap. This is the gap this morning. And do we continue down to the July low? Okay.
Okay. It feels like this present market is looking to punish momentum traders, as we saw the past 2 days with extreme ranges and both buying and selling tails. Yesterday's volume seemed to have increased as the day went on, and the market was selling off. How have you observed the volume lately? Any market generated information?
The volume hasn't told me as much as I would like it to tell me, but understand that we look at NYSE volume. That's the best source we have. That is actually it's a poor source because there's so many ways that orders get filled these days that we don't see. So the volume's been a little heavier, but from when I look at NYSE volume, there's nothing that screams out at me. But you're right. There's been a tremendous amount of volatility. But understand what that volatility is. Short-term traders continue to buy every break. And what happens, this is why I suggested take a coin, take a half a dollar or a quarter, spin it on your desk, and you see it's got a lot of energy to start with until it goes flat. That represents to me the short-term traders, it's like the quarter. They're buying every break. They're getting less and less and less. And then finally that quarter goes flat. And that's the question is, here we are this morning. Has the quarter gone flat this morning? We're right down at the, where we could gap lower this morning. So I think it's important, but I think that to understand the short-term traders, they do what works till it doesn't work anymore. You got a tremendous short covering rally yesterday because the previous day you got some strange break late in the day that got the market terribly short. And when a market's too short, it always has to take care of current business first. Current business yesterday was the short covering, and then of course momentum players jump on board to the short covering. But if you notice when that market was going up yesterday, there was a 2-day high up there. I think it was a 2-day high. The market came back to it 4 times before it went higher. That was the clue. That was the clue to me that what we were seeing was very weak hands buying in there. And I thought that probably a pretty good chance the market was going to give way, which it did. And remember, short covering can weaken a market. If market's too short, it supports the market because the only way you can cover short is to buy. Once you remove that, it weakens the market. So we got the short covering yesterday, it weakened the market. Then you came down and had the sharp break. Okay, other questions?
Yes, okay. We had an excess in the I period. I assume that they're referring to yesterday here. Let me split this out. And they said, and we are potentially opening lower in range when we open. What's your take on the 4501.50 price level, which was the high of the K and L periods, right up here?
I mean, it was there. It's one data point. Okay, it's one data point. There's all kind of, too many times people take one data point and they overweight it. Was I aware of it yesterday afternoon? Yes, I was. But value and everything else is far more relevant. And of course, now you had when you look at the fixed income market, like I say, you're soft again on the yields are rising, so you're getting pressure over there too. Okay, what else?
Okay. Is the market profile tool helpful in analyzing high volatile stocks? What adjustment to TPOs or setting or timeframes ticks per unit should be made for better clarity?
Number one, the market profile is nothing more than a distribution curve. It just simply organizes the market's continuous two-way auction process. Doesn't tell you to buy, doesn't tell you to sell. We are not market profile traders. We are discretionary traders. The more volatile a stock is, I look at the range. I very seldom if it's a really wild stock, I very seldom go over 4 ticks. I want to make sure that I don't lose too much detail. On the ES, I never go over 2 ticks. And the others, I never go over 4, rarely. Okay.
Right. What I'll just add to that is, the caveat is you need to know the nuances and quirks of each instrument or stock that you trade. You're only going to know that by observing. So just, observe it over time, see what is being respected, and you can make a decision over a period of time with regards to what your tick increment should be for that instrument.
What you don't do, you don't, sometimes people make a mistake on really wild volatile stocks and they make it so it fits their screen. That I found can be take too much damage away or too much clarity away. All right, final question, and then Jen will address questions if anybody has about the.
There are several questions here, Jim, if you happen to want to stay a little bit longer.
Oh, sure. Okay, I got time. I'm okay.
Okay. We have more than one person asking a similar question about the 50-day SMA. That, yesterday's low was at the 50-day SMA from some months now. Short-term traders have been buying exactly at the 50-day SMA. And another person was saying, I haven't seen that on your chart, but I know that you used it before previously. He only puts it in his bar charts. It won't be on the profile charts or anything like that. But people are just asking, are you still using and observing the 50-day
Yes.
SMA?
The answer is yes. I must admit I didn't catch it because I was looking at other things in here. But yes, I use the 50, 100, and 200 day just to really have a better idea of what traders are doing.
Okay. How much correction of overnight inventory can be considered complete? Should the market touch a POC or a value area level to consider the move complete?
No, I never do away with the word complete. It's never complete. You're basically looking to see, do you get a counter auction? Get the idea of completion out of your mind. Just say, did you get a respectable counter auction to it or not? Very seldom does it complete all the way. I mean, yesterday did, but okay. So now the market, we have the gap trading guidelines are applicable this morning. Okay. What other questions do we have?
Okay, because we were talking about overnight inventory, we had some other questions. Could Jim comment further on the overnight inventory being 100% short? Overnight prices did trade above the close last night. And another question related.
Yeah, you're fair. That's a fair comment. We did. It's not 100% short, but it was in my mind. I'm just looking to say that basically it's short in it. But you're right. It's not 100% because it wasn't 100% below the settle. But overall, it was short. And every time it rallied, they sold it off again. Okay. Thank you.
If the market were 100% net short during the overnight, would that 70% correction still apply?
Yes. They're just odds. They're just odds. This thing isn't a formula or anything else. Okay.
Okay. Jim says that if the market holds the initial reaction after the numbers until the open, it may develop a tone for the day. Do you think that applies today?
No, I talk about that for the when the jobs report comes out. I don't do that for anything other than the jobs report. But right now, it's what we're dealing with is the gap in here. Okay.
Okay. What is one of your first indications that commercials are involved today? In other words, when an individual price means little and getting filled is paramount.
I don't spend any time thinking about commercials. I just look at the market overall. I'm looking. So usually it's usually more institutionalized money. When you hold the gap down here, that's usually more institutional money. But remember, we're to that stage. Remember, I opened this by talking about stage 1, stage 2, stage 3. And stage 3 is where you get into the point where you're getting liquidation for more serious money. Now you're looking to see, can they carry through, and can you see a cessation of one time framing as we go into September? That's how you measure what's really going on in the market. But there's no, the large money is, I tell the story over and over again. Years ago, I worked with one guy who, one of the hedge funds paid him $5 million in commission one year. Nobody knew he was doing business. They thought he was just trading for his own account on the floor. But he actually was doing this commission business. And that was 20 years ago. But think now how many ways they've gone to hide what they do. And as I always say, if an institution lets you know what you're doing, what they're doing, they're buying or selling, you don't want to know. They're trying to suck you into something. So you have to you're never going to be 100% sure, but you're looking at, that's why we look at value. That's why we look at gaps to see what is really going on. But that's why I started off with the phase 1, phase 2, phase 3 to identify what goes on in the market. And we're now in that phase where if there's any serious selling, it starts to magnify itself in here. They feel pressure. Institutions don't panic as much as you and I do, but they panic. They just wait longer. Okay. So the market, we've gapped lower. They're now making an attempt to trade higher. Any real, if you fill the gap in here, then you're start looking for this, how developing value. Okay. Anything else?
Somebody's asking, so do you consider yesterday, Shin, that it was a long liquidation day?
Oh, I think yesterday was, yeah, I think there was some long liquidation in there. Absolutely. Absolutely. Okay.
Okay, and then we're gapping lower, but we're also breaking from a 3-day balance. Is that how you view it?
Not really. That's fair, but I'm more focused on the July low than anything in here. Okay.
Okay. Then I think we've gotten to all the questions that we had.
I'm going to sign off, and I'm going to let Jen take over and address any questions on the educational courses. Thank you all.
Okay. Thanks, Jim. So yeah, just somebody had asked about the schedule for the intensive. So yeah, if you go to the courses and you see the intensive featured up at the top, or if you're on the page, there is a blue link to click for the schedule so that you can see the timings of all of the webinars. They are posted in Eastern time, and you'll need to convert for your time zone, whatever that may be. And like I said, the prerequisite requirement is the foundation and application of the market profile e-course. I can't stress that enough. The only way you can get grandfathered through is if you have, we can verify that you've done a full intensive with us in the past, then you can bypass the foundation e-course. Otherwise, like I said, I'd recommend that if you haven't done the foundation e-course and you want to join us, you might as well get a nice discount for purchasing more than one course. And so you can go and see our limited time special bundles. And like I said, the early bird pricing, which is the best pricing, purchasing early always yields you the best price. This would be the one to go and get right here, the foundation e-course and the intensive bundle, if you are wanting to join us for the intensive, but you haven't done the prerequisite requirement yet. And as I've said before, if you've got any questions about which course is right for you, or you need some clarifications, shoot us an email at dalton@jimdaltontrading.com or give a call at the number at the bottom of our website. And I hope you guys all have had a great summer, hopefully not not frying like we are down here in the South, but have a great rest of your summer. Hope you will consider joining us for a course. Thank you very much. Have a great weekend.